Good morning, everyone, and welcome to our weekly edition of the OakBridge Weekly Market Update. We are excited to have you here with us, and especially on this week of Christmas, we want to wish everyone a Merry Christmas and Happy Holidays. We're grateful that all of you are able to join us today. We've got a little bit of information for you today, and we're going to just jump right in with this. So JP Morgan, last week we had new numbers come out for inflation and what the inflation meant. We also had the Fed meeting last week and talking about where things are at and where they land with regards to their intent to continue to raise interest rates. And a couple of things have happened. Number one, the inflation came down much more than what analysts were expecting it to come down. So that was the first big item that happened. And the second big item that happened was the Fed seemed pretty unfazed by it and tended to be really quite continue to be hawkish, meaning that they want to continue to increase interest rates on the pace that they have previously noted in their playbook and what they're trying to accomplish. And I want to talk a little bit about that very specifically. So even though everything came down, industrial production came down, manufacturing and services came down, retail sales came down, everything was pretty much down. What the Fed took note of, however, is that they said that what they are tracking is core services, which includes all of that information that I just mentioned, minus housing. And so there's really not an index that tracks that. And so what JP Morgan did was they went ahead and tried to reconstruct that to the best of their ability to kind of see if they were missing something. Because right now, based upon JP Morgan's charts and what they're looking at and where things are going, they just don't see what the Fed is talking about. And so it is a little bit of a conundrum. We can see here on this chart that this is specifically JP Morgan's forecast with regards to the core services ex housing inflation. And you can see in November 2021, it was up to 5.2, and now it's clear down to 3.3. So it has come down substantially and is expected to come down substantially for the end of the year. But based upon what the Fed is saying, they're saying that they're not seeing that much movement in this particular index. So there's a little bit of disconnect here as far as what's happening and where things are going. I think that the biggest thing that we have to work with right now is just the saying goes, don't fight the Fed. And it looks like that interest rates will still go up a little bit next year. They probably will be less than what they have been this year, substantially less. And bonds at that point in time, as the Fed kind of tapers and starts to begin to allow the economy just to sit for a minute to see where it is and what's happening, as that taper starts happening, or even just a pause that's happening, you'll see bonds pick up quite a bit. And many of you have bonds in your portfolio, and that piece of the portfolio has been hit almost as hard as the equities have been hit over the last 12 months. And so having the bonds start healing and on a fairly progressive basis should be welcome news for us for this year. And we're anticipating that more than likely will happen. So again, stay tuned. We'll keep you up to date. We'll keep abreast of what's going on in the marketplace. And thank you again for tuning in and watching. We very much appreciate everybody and everything and are grateful that you're here. Thank you, and have a Merry Christmas and Happy Holidays. Thank you. Bye-bye.